The fire sales have started. I'm your host, Steve Van Metre, and thanks for joining me today. And our lead story today, the global fire sales begins as institutions are now forced into mass liquidation. And from a consumer perspective and investor perspective, this is bad news. But just wait, it's even worse for the banks that are holding on to a lot of these debt and could send us right into the next banking crisis, as you're about to see. Plus, we have a sponsor for today's show. Spectre Holdings is back. They just have a big announcement as their aircore technology is being installed in Canadian trucking fleets. As you may have noticed, after we feature a stock on our show, it tends to take off, and we think that Spectre is the next, and we're going to show you a setup that we think its stock price could double. You want to check them out on the NASDAQ under symbol SPEC. Stay tuned to the end of the show or check out the pinned comment or description for more information. Now let's go to Bloomberg, where we picked today's story up with a headline: is China's Country Garden gets winding up petition in Hong Kong. And this is dangerous news, because when you start to see the term winding up, it indicates that a company is not paying on its debt and the investors have had enough of it. They've gone to court now to push the sale of assets so they can get repaid. Now you think about this from the consumer perspective. You're going to buy a house, and what are you finding out? That the developer that you might be buying from can't pay on its bills. How about as an investor? Well, you certainly don't want to put more money into the sector because you already know they're not paying their bills. And from the bank's perspective, well, this puts them in a situation when the fire sales hit that they're going to have to start writing down their assets. And then when we look at the banks there in China, we already know they're insolvent. Well, now the situation only gets worse. The first hearing date is scheduled for May 17th at Hong Kong's High Court after Evercredit filed a so-called winding up petition dated on Tuesday. And Country Garden failed to make payments on a term loan facility for about $1.6 billion or $204 million US, plus accrued interest to the lender. And this is, of course, a lot of money. Now, if you've never heard of a winding up order, it's just simply when a company is legally forced to liquidate assets to pay on a debt. And this is brought on suit by a company's creditors because they're often the first to realize that a company is actually insolvent because their bills have remained unpaid. And again, this comes back to what is China trying to do to their housing market. They're trying to revive it. And of course, as a consumer, if you're going out to buy a property, this does not inspire confidence at all that in fact that when you buy something that is going to actually get done. Because remember, in China, you buy up front and then you wait until it's done. Not like it's done here in the US, where you just put a deposit down. The petition is the latest in a slew of liquidation demands that have been filed against developers this year. It may add to the dour sentiment plaguing China's troubled property sector. In fact, almost all of the real estate giants have defaulted or are facing liquidation lawsuits or are likely to do so, underscoring the downfall of an industry that was once regarded as a linchpin as the Chinese dollar bond market. In fact, Country Garden's dollar bonds traded deeply distressed levels of around 8 cents on the dollar, showing how little money investors expect to recover after somewhere near 80 cents in June. So of course, now they've gone to court to say, look, we want to force the liquidation of assets. We want to get our money back because we have no confidence that they're going to pay us back anytime soon. And Country Garden says debt that involves Kingboard accounts for a, quote, very low proportion of its onshore liabilities. I love that. The radical action of a single creditor will not have significant impact on the company's delivery of homes, normal operations, and the overall restructuring of overseas debt. And so what this last part here is, this overall restructuring of overseas debt is critical because we already know what they're doing. They're going to their borrowers and they're saying, look, you ski, we can't repay our debt. So we either want you to take a haircut, we want you to cut the rate, we want you to extend the terms, because otherwise you're going to have to go to court as well and go look at our assets. They're going to come down in value as soon as these fire sale prices hit, because when you start to see what's going to happen when these companies go to unload these properties, they're going to get pennies on the dollar. The banks are then going to find out that their valuations of the properties they hold notes against are going to come down. Everything's going to get written down. Nobody wants to see this happening, giving, of course, these property developers some power. That is telling the courts get involved. The builder, which is at the epicenter of China's property debt crisis, is facing a petition filed by Everclear after it failed to repay a term loan for about, like I said, $204 million US. Of course, Country Garden notes this represents a fraction of its offshore bonds, which total about $10 billion. Of course, the danger here is other investors are going to start to worry that they're not going to get repaid either, and they're going to want to get in line the moment the Country Garden stops making payments. Of course, we know Beijing is running to the rescue, but despite the fact that we see, of course, bailouts coming to the sector, doesn't mean consumers will come and buy property. That is the key part to all of this. You can prop things up and make it look good, but if consumers don't buy, then the system has even more leverage, and only it gets worse when the downturn finally hits. As China's Evergrande Group, which was once the world's most indebted developer, received a liquidation order in Hong Kong last month after a petition filed by an individual investor over borrowings worth about $862.5 million. Country Garden said it's 135 projects, which is a staggering number, included on local authorities' whitelist. Here we go. For financing support, that the winding up position wouldn't affect its ability to deliver new homes. So here you can see on one side they can't pay their bills, but they're on the list to force banks to lend to them because that's what Beijing wanted. Remember, Beijing said, we've got to get confidence restored to the housing market. We have to get people to buy. The only way to do that is to get money back in the hands of developers who seemingly have none, and now they're forced to borrow more. So think about this. What will happen when consumers don't come and buy these homes because the global economy continues to slow? What that means is these banks extending these loans and these property developers are just going to outright get decimated. And as we know, of course, the banks there are already insolvent, and this in turn puts pressure on the U.S. because as we look around to China, why are people having a lack of confidence in buying homes? Because they're looking at the global economy. They're looking at consumer demand, and they're concerned about their jobs there in China. Of course, that all comes back here to the U.S. As Goldman CEO sees more uncertainty to soft landing expectations, which the base case right now seems to be no landing situation. The world is set up for a soft landing, Sullivan said at the UBS Group conference. The market certainly perceives there's a very, very high delta to a soft landing. My own view, it's a little bit more uncertain than that. Of course, you know that our view is there is no chance of a soft landing. There will be periods where it looks like we've achieved it. And then, of course, in a matter of months followed, there'll be more data that suggests, well, we didn't achieve anything at all but a brief celebration. Solomon said business chiefs have told him that with prices still high, a pattern of tightening and paycheck-to-paycheck spending behaviors has emerged. And the question then is, why is that? Is it because consumers are maxed out on their credit cards? Is it because they've tapped out all of those buy now, pay later loans they can get? Or is it the fact that their paychecks aren't keeping up at the same pace? That's really the story here as we look at advanced retail sales against total compensation. That's shown in red, which is a function of average hourly earnings multiplied by average weekly hours of production and non-supervisory employees. And what did we know last month? There was an outright crash, mainly in total compensation due to a drop in hours worked. We can see the retail sales shown in blue follow that very clearly. So demand here is definitely going down. We'll be eager to see the next report to see where this trend is going, if that was a one-off situation or not. But what we note is that demand in the U.S. is slowing. That in turn affects Chinese factories, affects Chinese consumers' desire to buy homes. And then you see Beijing pumping the sector up with money. It's not going to play out very well. Investors will keep repositioning in a slower economy, Sullivan said, as investors are repositioning a bunch right now. Well, that means they're really buying just 5 U.S. stocks because it seems what everybody's doing, because 2 minutes ago was 7 interest rate cuts. Now it's 4. So the velocity of activity is still good, but what investors can't see is that when you overlay total compensation against the U.S. equity market, periods where you see a long trending decline in total compensation means people have less money you put into the equity market. It also means more people on the unemployment line, and that is generally not good for the equity market. You can see that heading into, of course, the dot-com bubble, the global financial crisis, what looked like the beginnings of a double-dip recession following the GFC. You see that happening here again going into that 2014 through 2016 period where many thought we were going to head into a globally synchronized recession. And look now, Everyone's keyed on a big booming equity market as paychecks seemingly get smaller and smaller. And here's more evidence of the U.S. economy headed the wrong direction as we head over to Texas and look at the manufacturing activity index, which merely just stabilizes. So if we are going to experience a soft landing, then what we should hear is a lot of hope that right now things are bad, but we're so optimistic about the future. We can see things turning around, and we really don't see that here in the Texas report at all, because what they can note is that after stabilizing in February, after contracting in January, this according to Business Executive, the production index, a key measure of state manufacturing conditions, rebounded 16 points to 1. The near zero reading suggests flat output month over month, and that is not actually a good sign. If there is any hope here, the new orders index, a key measure of demand, shot up 18 points in January to 5.2. Get this, the first positive reading since May of 2022. We'll show you what was driving that, but let's look deeper here, because perceptions of broader business conditions continued to worsen in February, though the indices were less negative in January. The general business activity index increased from minus 27.4 to minus 11.3. Keep in mind, when you see those negatives, that is a further contraction in the data from the prior month, suggesting that things in Texas just aren't getting better. They're just not getting worse faster, which is the case here. And we can see the outlook uncertainty index retreated 10 points, not a good sign. But let's talk about the labor market, because nobody, not including those central elites, believe that anything can break the U.S. labor market. But here you see in Texas, labor market measures suggested growth in employment, but shorter work weeks this month. That is the key thing here, that you continue to see signs that employers are cutting hours, and that is an issue. They're forced to give them more money per hour in terms of a raise, but they turn around and cut their hours because there just isn't demand. Let's take a look at some of these survey responses. One of the neat things about a Texas report is we actually get to see some of the responses. Here you can see in food manufacturing, sales were below projections for January and February. March is not looking good, and current employee hours have not been affected. But if sales do not return to normal soon, we'll be cutting hours. How about textile products? There was not much movement between February and January. Looking at printing, we're slow at the moment, and we hear others in our industry are slow. Even in the chemical space, we're seeing a pullback from our client orders. That is not a good sign. How about in plastics? They said, I have no idea what's going on. Primary metals, uncertainty has increased in our general legacy business. That doesn't give anybody confidence. But here's one, perhaps someone from maybe who watches the show out of machinery manufacturing said there's an odd chill in the air that we can't determine if it's election related, general economic beliefs, or fear of pending doom. Of course, that is not good signs of what you would see in the data as a soft landing or a no landing scenario. But what drives really the economy in Texas is none other than crude oil. So when we look at these new orders, we see this big increase in jump from that downward trend. Well, we note that crude oil is not responding in that same trend, suggesting that this one-off month and new orders will be reversed as we look forward. And we see, of course, perhaps impending doom about to strike Texas. And of course, what do we note in the data today? We see the inventory levels suggesting demand for energy is going down. As we look to the Department of Energy, crude up 4.2 million barrels. Cushing inventory is up nearly 1.5 million. Gasoline down 2.83 million. Distills down about 500,000. Of course, my contacts note that a lot of these tanks in the product space were full, and so they needed to bring them down a little bit, bringing production at the refineries down a little bit to compensate for that. But let's dig deep now into the Texas PMI data here, and what we find is growth rate of orders is slowing down despite an increase in new orders. Look at this, unfilled orders contracting at minus 13.7. This is that backlog, that critical thing we talk about, that when these get eaten away, well, you don't need employees anymore because you don't have enough new orders to keep them busy. That is why we keep seeing a cut in hours worked. And sure enough, we find that here. Notably, they're still hiring. Maybe they're trying to find some people that are more qualified. It's hard to say. As they cut hours, it doesn't really add up. Something here is going to change in a big way in a matter of months. And then we head over to Richmond. the 5th District and take a look at their manufacturing activity, and it was flat in February. Again, you look at what Goldman's saying here is there's really not signs of the soft landing materializing. We look over at China, we see nothing but stimulus being pumped into their housing market in hopes that something changes, but what's not going to change is likely a U.S. economy that's going to bail out, of course, China and other exporting nations. As we see the composite manufacturing index increase from -15 to -5 in February, which means it's still contracted just at a slower pace. Shipments remain solidly negative. New orders did increase from -16 to -5. And employment rose notably from -15 to 7. So we continue to see this kind of buy-in scenario where everyone believes that the Federal Reserve really got this right, that perhaps there is a soft landing or a no landing scenario, but it's not materializing in sales. And that's the issue of why I showed you that chart of advanced retail sales against total compensation, because if we continue to see the trend of total compensation growth slowing, there's no chance that the U.S. economy is going to experience this mythical soft landing at all. In fact, most firms continue to report declining backlogs as the index remained negative. The vendor lead time index increased from -3 to 4 in February. Capacity utilization, or how much the factory is being used, rebounded a little bit, but still remained in contraction territory. Digging a little deeper here into the 5th District, we see new orders, negative, backlog continuing to eat away. Again, this is going to affect employee hours worked and eventually jobs in a big way. Capacity utilization down. They don't track hours worked, unfortunately, in the 5th District, but you can see they brought on some employees. Again, kind of baffling what we see as a trend that they're cutting hours and yet hiring people. But we can tell you the total compensation trend is all that really matters here, because when U.S. consumers see their paychecks shrinking, their hours worked going down, well, their demand for goods and services falls with it, and that eventually hits the manufacturing sector. As we look here to the 3rd District of Philadelphia, where we notice that the current general business activity index in blue heads down right alongside total compensation shown in red. Here you can see total compensation heading down, factory orders heading up. This may be, as I make the case, the Red Sea effect, kind of giving U.S. manufacturers kind of a little bit of a renaissance period, but what's not being backed up is by U.S. consumer demand. That we're going to see a continual downward spiral. We'll be eager to see, again, the next set of data, but something we're also eager about is to see how things are going for our sponsor of today's show, Spectre Holdings, because we believe big things continue to come for this company, and what that means is big things for their stock price. You can find them on the NASDAQ under the symbol SPEC. We're going to make the case of why their stock price is set up to double. Stay tuned. Let's check them out. Again, everything you need to know about Spectre is in the pinned comment or description below. Let's take a look at what's going on, because they just announced new demand by Canadian trucking fleets for deployment of their AirCore technology in response to escalating carbon credits, and they have just announced successful installation of its AirCore technology. This initiative is poised to provide a sustainable solution that aligns with a national agenda for reduced carbon emissions, while also developing a path to mitigating the economic impact of tax legislation on the trucking industry. You're going to see a lot more companies needing to have Spectre's technology installed so they can monitor their carbon footprint, so they can make the necessary changes to stay within the regulations. And that's really the big story about Spectre. And here you can see that this year in April, Canadian truckers saw a significant increase in carbon pricing, a 30% increase to $65 a ton, translating to an increase of about 70 cents of carbon tax payments per liter of diesel fuel. And here you can see an executive director for the Saskatchewan Trucking says driver operating a truck with a 300-gallon tank would be paying about $193 more to fill, and an average of about 106 fills a year. This put the cost of carbon tax payments of more than $20,000 annually for each truck on the road. And the adoption of AirCore by multiple Canadian trucking fleets represents a proactive approach to facilitate industry-wide emissions reductions in alignment with increased federal and provincial carbon taxes across Canada. This development underscores Spectre's commitment to delivering innovative solutions that address both environmental and economic challenges facing the trucking sector. And here you can see the general director of GNS Direct highlighted the operational and financial advantages conferred by Aircore. Quote, our collaboration with Spectre through Aircore not only signifies our dedication to environmental stewardship, but also enhances our competitive positioning, facilitates potential tax benefits, enables the generation of carbon credits. We've served over 240,000 customers over 30 years with 60 trucks and over 100,000 square feet of warehouse space, and have invested in carbon reduction technology. We want to be able to publish and benefit from these investments. So look for more exciting news from Spectre. But something that we're really excited about is you'll note that many of the stock prices of our sponsor take off like a rocket after we feature them on the show. And I want you to see Spectre under the NASDAQ symbol SPEC is ripe for such a move. We can look back here and we can see back in late November and through December into January, price hovered right around the supply zone and just didn't seem to pick up any activity, and then all of a sudden shot out of nowhere. Right now it's sitting at $1.41, setting up a move right into that supply zone. You see it happen once, it pulled back and launched up there again. We're seeing this now sitting back here in the deep into the supply zone, looking for a catalyst to send this stock, what we believe could easily double in price, maybe even get up into the $4 range as you saw here back on one day. So a lot could happen here in a big way for Spectre. Again, check them out on the NASDAQ on the symbol SPEC. And as always, with any company we feature on our show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.